Welcome to Investors Guide. You're watching ET Now. I'm Faye D'Souza. Thank you so much for tuning in. We're going to try and over the next half an hour, figure out how you can manage your portfolios in a way that is stress-free and most efficient. On the show this week, we'll help an investor save enough for his child's education, something we all like to do. In our product review, we look at the Sundaram Select Midcap Fund, and we'll find out if you should be concerned at all. And if you're already concerned, we'll tell you what you should do about it. And for first-time investors, what should your investment strategy be? All of that coming up later on the show. All right, let me bring in Kumar. Thank you so much for joining us. It's a wonderful week. The market continues to be volatile, but we are focusing on our long-term portfolios, I want you to quickly address just one question for me. There are a lot of analysts right now, if you watch business channels like the one that we're watching at this point, there are a lot of analysts who come on these channels saying, you should focus on a particular sector, you should focus on infrastructure, you could focus on, sectors that involve using crude as a raw material. And investors might be thinking, okay, maybe that's a good idea, maybe that makes sense. But like we always say on this show, it's important to only stick with your plan. What advice would you give someone who's considering focusing on a particular sector at this point?
Ask yourself a question that, are you an investor or are you a trader? If you are a trader, then on work days and business days, watch the, try and make sense of it. But I think, our program is targeted to investors, people who save. That is why you hire a fund manager. Or if you have built your own equity portfolio, then choose some good companies, great companies, and diversify, follow some basic rule and be at it. Never, invest a big amount at one go. Don't redeem all your investments or don't act in a haste. So these are basic principles, prudent principles to be followed with your savings. Only put your long-term money into equity. So if one is following all this, I don't think you have to worry about at all.
That's the important thing. Are you an investor or are you a trader? And if you're an investor, then simply stick with your plan. Everything else is just surround sound and noise, nothing that you should be paying particular attention to. Then if you have a question, this is an interesting question. Gopalakrishnan has written in. He's a retired PSU employee. He doesn't have any pension, though, he tells us. He has funds worth 25,000 rupees per month parked in a bank FD. So the interest it generates is about 25,000 rupees. He has a PPF of 22 lakh rupees. Additionally, he has health insurance, and he would like to spend about 5 lakh rupees on foreign travel in the near future. 3 to 4 lakh rupees on a wedding in the next 2 years. He wants you to recommend a couple of mutual funds that he can look at. So it does seem like his immediate needs are looked after. He doesn't have anything helping him beat inflation over the long term, Dhirendra. Is that something that he should be using mutual funds for?
I would say that, he should seriously consider moving a part of his money, and in 2-3 years' time, once his PPF is mature, then he will, he can move a part of that money. So he should definitely work towards moving, retaining his allocation to fixed income so that his monthly income is met. And a reasonable part, I would say, the money which has accumulated in PPF, if it is unlikely to need it for consumption, a reasonable part of that should methodically find its way into conservative equity allocation, and say a balanced fund or even a more conservative allocation. All that money should not be invested at one go at any cost. He doesn't have the margin of going wrong after catching a market peak. So being very conservative with your participation in equity, approaching it carefully, cautiously or conservatively with a balanced fund, and maybe more conservative balanced fund. So if these two things are, if he's attempting these two things, if he's approaching it like this, there's a great possibility that he will not only be able, he will be able to beat inflation with his overall return. Because nearly 50% of his money has to necessarily be in fixed income, and then clean up his portfolio otherwise. It's extremely important, because otherwise he runs the great risk of outliving his savings, which could be not a very desirable outcome.
All right, so conservative balanced funds are on your screen right now, and a quick recap of what Dhirendra said. Use an SIP, use a conservative balanced fund, but you must be investing at least a small amount of your money in equity in order to beat inflation over the long term. It's absolutely necessary for your portfolio. If you need anything else, you can reach us. We're exactly here on this show week on week. Let's move on to our portfolio question. 30-year-old Nishant Tripathi has written in from Delhi, Dhirendra. Very interesting case. He wants to build a corpus of 4 lakh rupees for a home he's going to buy in the next 20 months. 10 and 15 lakh rupees for his child's education and marriage over the next 20 years. Now, between him and his wife, they take home close to 11 lakh rupees. This is the problem that I'm having with this portfolio. LIC Money Back, LIC Jeevan Anand, Birla Sun Life Dream Endowment. So there are 3 endowment traditional plans that they're using between the 2 of them. They also have the PPF and the National Savings Certificate. And then they have a health saver fund. Now, all of this put together, if we put that in one basket, in the other basket, he has term plans for himself and his wife at 50 lakh rupees each. He has health insurance and he has mutual fund investments of close to 9,000 rupees. So I would ideally like him to take all of the money out of this first basket and move it into the second one. Does he need to continue to hold on to those endowment and traditional policies?
No, absolutely not. In fact, he should hurriedly, plan his exit from those funds. And it might look painful, once you realize it is actually a very classic dilemma every investor faces, that you have put that investment and you realize that and investors are anchored to the amount that they have invested. And once you realize that you are likely to get 40% less, you gave 10,000 rupees and you are likely to get only 6,000 or 5,500. There is generally a tendency, there's an inertia, you stay put, you do nothing. That could be injurious because one should be admitting it as a mistake. And because, he has actually approached his finances very methodically. He has gone for the term plan. He's looking at his requirement in a time frame, and he's working to prepare for that. And mixing investment and insurance through this traditional policy is injurious to your savings. So he should methodically exit this and consider, appropriate mutual fund for his various goals. The money which he needs in 2.5 years should be ideally in a recurring deposit or in a short-term debt fund at most. And that is unlikely to generate substantial return, but it will generate reasonable return. He must have that in emergency fund, and after that, rest of his money is long term. And that long-term allocation he should start right now, and that will undergo a reduction. That will reduce a bit or quite reasonably when his EMI starts for him after he has bought his home. So he should plan it in that manner that long-term money should be in equity. Short-term money, or the money which he is likely to need in 1 or 2 years, 3 years, should be in fixed income. He has taken care of, he should revisit his need for term insurance and is it adequate. His need for term insurance will go up once he has bought that house, and that's all that you need.
All right, so this is what you need to do. Whatever money short-term in a recurring deposit, as Dhirendra said, you need to have a long-term equity allocation and, of course, reassess your needs of your term policy once you buy that house, because if you have a home loan, then you need to have a higher term insurance policy in case something happens to you. That term insurance policy should also pay off the entire outstanding on your home loan. Dhirendra, let's take a look at his mutual funds. Access Equity, Birla Sun Life Top 100, DSP BlackRock Microcap, HDFC Top 200, iPro Discovery, L&T Equity, Reliance Small Cap Growth, and his wife has Birla Sun Life Equity. Now, these are all great funds. They're all good performers. But is there a coherence in the way he's put them together? Would you like to tweak that a little bit?
Not really. In fact, they are all excellent funds. They have done very well in recent times, recent years, and particularly last 1.5, 2 years. And that is perhaps the time he would have started. And in chasing past performance or funds which are doing well, it gets easier for investor to get started with them. But I don't think it is reflecting anything. In fact, his strategy will undergo a radical change, because all the endowment plans which he will surrender and discontinue will, he will have a new need, which is investing for saving taxes. So he should consider, consolidating all his money into 1 or 2 tax-saving funds and avail that 80C benefit to the hilt, to the maximum possible he can. So this 7,000 rupee going into 7 funds should get reduced to 1 or 2 tax-saving fund, and that should be good enough. And that's very important, because making investment in equity fund, whereas you, on other hand, if you are giving up on an opportunity to save tax, as well as saving in, making investment in equity, I think it's a deprived it's a missed opportunity.
All right, so what we've done is we've pulled up the tax-saving funds that we recommend on this show right now. There are two sets. There's the aggressive tax savers and the slightly more conservative tax saver. Given your age, of course, aggressive seems better suited for you. Before we go into break, there's some good news coming in for armed forces officers. We've been watching this on the news for a while. The government has finally given its thumbs up to one rank, one pension. Now, if you want to understand what this means for defense personnel that are retiring or already retired, here's a quick report on everything you need to know about the change.
Same rank, same length of service, same pension. One rank, one pension will equalize pensions paid to retired armed forces officers regardless of their date of retirement.
Despite the huge financial burden, given its commitment to welfare of ex-servicemen, the government has taken a decision to implement the OROP.
The government rolled out one rank, one pension last week, effective from July 1st, 2014. The scheme will take 2013 as the base year for calculation, and arrears will be paid in 4 half-yearly installments to all retired servicemen except widows, who will be paid in a single installment. Veterans will get an average of minimum and maximum pension in 2013, and those drawing pension above the average will fall under the scheme. But there's a catch. The government has agreed to revise the scheme every once in 5 years as opposed to an annual basis. Additionally, ex-servicemen who opt for voluntary retirement will not be included in the scheme. The government also plans to set up a single-member judicial committee to look into one rank, one pension. While the government hopes for all veterans to be on board with the conditions, most of them are not quite happy. For instance, benefits for premature retirees and yearly revision of the scheme have been major causes of disagreement. They also wish for faster implementation of the scheme. But good news is that the issue of one rank, one pension, which was hanging fire for nearly 4 decades, has finally been implemented, and a detailed government order is expected to be out soon.
Coming up after the break, Dhirendra is going to stay with us. We're getting a lot of questions about the Sundaram Select Midcap Fund. We'll try and address those questions on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide in ET now. Thank you for staying with us. It's time for our product review. And we've picked the Sundaram Select Midcap Fund this week. Ashish Pathak, like one of the other viewers that we've had, he's been investing in the Sundaram Select Midcap Fund. He's written in saying that he's not happy with the performance, and he wants to know if he should sell this fund and move his money perhaps into the Motilal Oswal Midcap Fund. What do you recommend, Dhirendra, for Sundaram Select Midcap? The performance has not been bad. Given where the market is, given where the entire midcap category is at this point, this fund has not been a bad performer. But we are getting questions from viewers who are looking a little worried about their holding in this fund. What's your response to that?
I would say that this is an outstanding fund. This fund started in 2002. It has given an annualized return of 20%. It has beaten its benchmark in almost most of the years in the last 10 years. It is among the top 1/3 fund in a large universe of mid and small cap funds. Incidentally, this category of mid and small cap fund also has many small cap funds which are doing which have done much better than the mid cap tilted funds. Despite that, this fund has been able to hold its ground much better.
So obviously these are tough times. So if I'm an investor right now, I'm looking at my investment, sort of regulate my expectations. What should I expect from this fund going forward if we assume the volatility is going to continue for another 6 months or so?
Don't lose the perspective. Look at 30% annualized return in the life of this fund since 2002. Look at 20% return. Sundaram Midcap is the best performing fund over the past 10 years. It has given reasonable return ever since the markets turn around.
So it's very important to remember that if you're investing in a mid-cap fund, any mid-cap fund, especially this one, you need to have the temperament for it, which means that you can't be someone who gets extremely nervous when you see the market come down, because mid-caps actually face the worst kind of volatility. Also, if the market does come down, you shouldn't have the need to take your money and go. So long term, strong stomach, good investor. Otherwise, you should just be exiting this fund. Dhirendra, could give us your rating on the scale of 1 to 5. Where would you place Sundaram Select Midcap?
Given that there are too many good funds that have come up in this category, I would still I will give it a notch higher than where it gets placed on our risk-adjusted scale. I'll give it a 4 star.
4 stars for Sundaram Select Midcap. If you're the kind of investor who can handle the volatility that comes from a midcap fund, it makes sense to hold on to this fund, especially for the long term. It is one of the strongest performers in its category. We're going to take another question on our hold or sell segment. This comes from a woman investor. Ratna Sengupta has written in Dhirendra. She tells us she's a banker. She works with Oriental Bank of Commerce. She wants to build a corpus for her retirement. Now, Ratna has not told us how old she is, which means that we don't know how much time she has before she retires. But she has sent us a list of the funds that she's investing in, and we do want to help her out. She has about 9,500 rupees going into these funds every month. Canhaiya Robeco Emerging Equities is the first on her list. They're aggressive funds that she's picked. For this one in particular, would you say she should go ahead with this SIP?
Yes, if she has never invested in equity and she has gotten she has started her investment in this one. Be prepared for big ups and downs here, but yes, it's an outstanding mid-cap fund.
She has 2 more funds in her portfolio, UTI MNC and UTI Top 200. Dhirendra, would you recommend she continues both of this? What's your view on the MNC fund?
MNC fund is something which has done exceedingly well, very well, and it has done very well because this fund, there are 2 MNC funds, and these funds invest in multinational companies, and multinational companies, incidentally, in India, are out of the cyclical businesses or the the commodity business, and these are the troubling spots in the Indian market. So that is why by their very design, these funds have kept away from a set of companies which have really struggled in the last 3, 4, 5 years. So what has not worked in India, these funds have no exposure by their very character, and that is quite accidental. So I would say that most investors should, when investing in equity for the long run and on a methodical investment plan, the only thing they should follow is diversify, and diversify in a manner which is not a constraint or it is not depriving the fund. So this fund has done very well, but it may not do very well in in the next 5 year, 10 years. If you'll see, the FMCG funds or the pharma funds, they look like the best performing category over the last 5, 6 years. But there was a phase, the phase of 2004 to 2008, when the market did very well, and these funds were able to deliver. These funds did well, but they were able to deliver only 2/3 of the return which was derived from the Sensex. So they were not even able to beat the benchmark. So I don't think we should lose that perspective. Over a long period of time, if you are onto investment, methodical investment plan, be in a fund which can invest all over, and these funds can't.
The last one on her list is the UTI Top 100 fund, Dhirendra. Would you recommend she holds on to that one?
Yes, it's a large cap fund and done reasonably well in recent times. And of course, this is the kind of fund which will give her a broad exposure with reasonable stability, and yes, worth holding. But I think she requires even a simpler plan. She should ask, can she invest in equity, and that will get her the tax break? Then maybe drop all these funds and invest in the tax saving plan, because the money which is going in these 3 funds, if it finds its way into a tax saving fund over and above what her provident fund deduction will be, and she can avail that tax benefit, that should be her first priority, then followed by 1 or 2 investment as much as she can save.
All right, so this is the plan. If you have room to save on tax, you should be using our list of ELSS or tax saving mutual funds. Those are on your screen right now. Just pick 1 or 2 of these funds and maximize your tax saving under Section 80C. And if you have more room after that to start investing, Dhirendra, if she has more room, then it's between the Canhaiya Robeco Emerging Equity and the UTI Top 100 fund. Would you like to add something else to that, or are those 2 funds coherent enough for you?
These 2 funds combined together make it, she will get a reasonable market exposure, and both funds are good. She should just increase her investment in these 2 funds as much as she can save beyond the tax saving fund.
All right, so first tax-saving funds and then these two funds that are on your screen right now. So continue that investment, discontinue the one that's going into the MNC. All right, Dhirendra, thank you so much for joining us on the show and answering our questions. Coming up after the break, we'll talk to young investors and we'll build an investment strategy for you. We'll find out how you should be investing your money. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. We're going to try and answer as many questions as we can about your asset allocation. Firoz Aziz from Anand Rathi Private Wealth Management joins us. Firoz, thank you for joining us on the show. Our first question comes in from 24-year-old Ankur. Ankur tells us he'd like to buy a home in the next 7 years. So he wants to set aside about 4,000 rupees every month. He also has to pay for his education loan. Now, he'd like to divide his investments between equity and the PPF. And he wants to know what the right mix is for that money. Well, first of all, Ankur, you should pay off your education loan, as the schedule is, because you do get a tax benefit on the interest that you pay. So that's something that is always an added benefit for a 24-year-old on your salary. Well, Feroz, if you were to help him split up that money, I'm not a big fan of the PPF. What would you recommend he does?
I think all your money should be invested in equity because you have 8 years to buy your home, and I think that's going to be a steep ask of a down payment even if you choose to take a home loan. So equity is going to be the vehicle, and some degree of debt just from a contingency perspective to absorb the volatility of the equity could be okay, but choosing PPF will not be a good idea because debt mutual funds can actually do the same thing in a better fashion because PPFs will have lock-in and other complications. In the equity category, you can look at two funds. One would be the ICICI Focus Blue Chip Fund, and in the mid-cap category you can look at Sundaram Smile Fund. These are two good funds which you can look at. In the debt category you can look at Reliance Corporate Bond Fund. I think these are the three funds you can invest in, and I think predominantly it should be equity so that you are able to buy your house when you're turning 32.
Our next question comes in from Suman Mishra. He says he has a lump sum of 10 lakh rupees. He'd like to invest for a term of 2 to 3 years. He wants to save on tax. What would you recommend, Feroz?
See, if you're investing for the short run, of course, debt is going to be the one vehicle which can be used because long term is when the equity volatility is actually smoothened out and actually the risk becomes notional. Since you've mentioned short term, as long as it's greater than 2-3 years, since you already have an ELSS exposure which you wish to take, I think that will be the more equities portion of it. The rest of it, I think you should look at doing debt because of the short term nature. So in the ELSS category, I'll recommend you an Axis long term equity fund, which is a very good ELSS. Now coming to the residual portion, which should be in debt because of the short term nature, you can look at ICICI regular savings fund and look at a dynamic bond fund, maybe an SBI dynamic bond fund.
Last question from Sachin. Has been investing 2,000 rupees a month in HDFC Prudence and 1,000 rupees in the iPru US Blue Chip Long-Term Fund. He wants to know if he's on the right track. He has some extra money of 3,000 rupees. He'd like to allocate that money. But I want you to take a step back and look at why you're investing in these funds in particular. There doesn't seem to be any core holding in your portfolio. Feroz, would you recommend a core holding, please?
I think it's a very good pick, ICICI Focus Blue Chip from a long period perspective. Then if you move to the other fund which you have, which is the HDFC Prudence Fund, it's a balanced fund. I would definitely not want to choose from long-term perspective a debt and an equity fund which is combined in one fund. So move that to maybe a Sundaram Smile Fund. I think that will be a better strategy from a long-term standpoint. And then I think the third, the extra money which you have, I think you can invest in Birla Frontline, which is again a large cap fund, because then you will have two large cap funds, one mid cap fund. I think that will be better.
That's a wrap on this week's Investors Guide. Remember, you can always write to us with your questions. We're right here and we will be week after week to help you with anything to do with your money. Tune in next week and catch the show. Thanks for watching.